Hey everyone, in today's video we're talking about the double taxation of Social Security benefits. I understand why the concept of paying taxes on Social Security benefits doesn't sit well with a lot of people. After all, you've made these contributions through payroll taxes in hopes of receiving a future benefit. Now these payroll taxes are after-tax dollars that were involuntarily taken out of your paycheck. And now the benefits you receive from making those contributions could be taxed again. That sounds a lot like double taxation to me. But in today's video, I want to take a deep dive into this and figure out once and for all, is this really double taxation? Stay tuned. Hey everyone, I'm Devin, and this channel is all about breaking down Social Security so you can use the rules to your advantage. If you haven't already, would you hit that subscribe button and be sure to click that notifications bell too. YouTube is a massive place now, and you can subscribe and never see anything that I publish again unless you click that notifications bell. That's the only way you're going to get notified when I publish a brand new video. And if this is not your first time to the channel and you get value from this, please hit that thumbs up button. Through the years, I've seen a lot of articles that attempt to address the issue of double tax on Social Security. But I've never once seen anything that adequately explained it in a way that was easy to understand. Most articles never go deeper than the surface level, which unfortunately only adds to the confusion. So after looking at this, I decided it was time for me to dive into the research and figure out once and for all, is this truly a case of double taxation? Now, you should know a couple of things right up front. First, I'm only dealing with federal taxation and not state taxes. Also, we're going to get into the numbers in this video, but I believe I've made everything easy to understand. So if a concept doesn't make sense at first, watch that part again and don't hesitate to ask questions in the comment. Okay, to understand the whole taxation issue, we have to put some context around this, and that starts with the history of Social Security taxation. Social Security benefits were not taxable from January of 1937, that's when the first benefit was paid, until the beginning of 1984. And at that point, there was a new bracket added where up to 50% of benefits could be counted as taxable income. And then in 1993, yet another bracket was added where up to 85% of benefits could be counted as taxable income. But where did these rationales come from on these law changes? Well, the original thinking was that since FICA taxes are paid with after-tax dollars, the benefit from them should be tax-free. Now, I like that way of thinking, but that all changed as a result of the Greenspan Commission. Now, back in 1981, President Reagan and Congress appointed this group to figure out how to fix Social Security. Much like we hear about today, the Social Security Trust Fund was very, very close to running out of money. So they had to do something, and they had to do it very fast. And the Greenspan Commission saw taxing Social Security as the low-hanging fruit to solve the problem. Despite the fact that there were 3 separate Treasury rulings in the early days that explicitly excluded Social Security benefits as taxable income. Now, the rationale for taxing Social Security benefits was based on how the program was funded. The taxes to pay for Social Security are 12.4%, but that's split into 2 pieces. Employees pay in half of the payroll tax, and employers pay in the other half. The difference is that the employer can deduct their part of the payroll tax as a business expense, but employees cannot deduct this expense. This meant that only 50% of payroll taxes that were paid in were already taxed. That would be the employee portion. And thus, up to 50% of a benefit should be taxable after it was paid. The Greenspan Commission believed that this would align the Social Security rules with the ones that already existed for pensions, annuities, and some of the other retirement savings plans. The way these work is that if you contributed after-tax dollars to your pension or annuity, your pension payments are only partially taxable. You don't have to pay tax on the portion of the payments that represents a return of the after-tax money that you put in. So in late 1983, a law was passed which made up to 50% of an individual's benefit count as taxable income. For the first several years, this tax didn't affect very many people, so there wasn't much pushback from taxpayers. But it didn't take long for the federal government to realize that they had been missing billions of dollars in potential revenue. So the next step was fairly obvious. That's increase taxes again. So in 1993, a second level was added, making up to 85% of a Social Security benefits taxable. Now, the rationale they used here to justify this tax increase was completely different than what the Greenspan Commission had used just 10 years earlier. The members of this legislative committee decided that the average worker who lived to an average life expectancy will only contribute 15% of their expected total lifetime benefit in their part of the Social Security payroll taxes. Therefore, the other 85% must come from other non-tax sources and thus should be taxed. For example, say someone earned an average wage and lived until an average life expectancy. They would most likely receive an average benefit of around $400,000 over their lifetime. But the employee only paid about $60,000 into Social Security through payroll taxes. So according to their logic, since that's the only part that's already been taxed, up to the remainder, the difference between that $400,000 and that $60,000 should be taxable. You know, at first I did not want to admit this, but the math here is mostly correct. A worker with average earnings who lives to an average age will contribute payroll taxes that equal about 15% of their total expected lifetime benefit amount. This means that if a maximum of 85% of benefits are taxable, there is no double taxation. However, this doesn't hold true if the worker's income was in excess of the national average wage. So, for example here, if you worked from 1972 to 2019 and earned maximum wages, and you live to an average life expectancy, you could expect your total lifetime benefit to be around $834,000. Now, if you have to pay taxes on 85% of that benefit amount, you have paid taxes on nearly $709,000 in benefits over your retirement. But you also have to include the Social Security payroll taxes that you paid in while you were working. Because remember, those are after-tax dollars. You've already paid federal income tax on those FICA dollars. And for an individual with that earnings history, your part of the FICA tax to fund Social Security would have been about $190,000. So for a higher earning individual, if 85% of your benefits are taxable, you've already paid tax on the original FICA contributions plus $708,900 in benefit payments. That means that in the end, you paid tax on $899,000 in income despite only having received a total benefit of $834,000. So effectively, you get hit with a double taxation of around $65,000 in income. So does this affect everyone? No, absolutely not. Unless your income while you're working and in retirement is higher than normal, you'll probably pay taxes once on your Social Security benefit. But if you're breathing a sigh of relief that you won't be impacted by double taxation, you might not want to rest easy just yet. Taxes could still be a very real issue when you retire. When Social Security benefits first became taxable, the change only affected the top 10% of retirees in terms of income earners. Now that number is nearly 60%, and it's likely to continue increasing because the brackets that were set in 1983 and then in 1993 have not changed. Now, there have been a few proposals to eliminate the taxation of Social Security benefits, but with an estimated $13.2 trillion shortfall between 2034 and 2092, I can't envision any proposal succeeding that would reduce any revenue for the Social Security Trust Fund, because ultimately that's where these taxes go. So taxes on Social Security benefits are probably here to stay. But just because taxes may be inevitable for some, you can still lessen the impact somewhat. Now, the most obvious strategy would simply be to lower your income, but that's not appealing or even realistic for most of us. One of the best options to do this in a way that's workable would be to build a strategic plan before you retire. Give you an example here. Distributions from a Roth IRA or the Roth side of your 401k are not counted against you in determining whether your Social Security benefits are taxable. You can have an unlimited level of income from these sources and still not pay tax on Social Security. So if you start now, your traditional IRA or regular traditional 401k balances, you might could take those and convert those to Roth accounts. Now, it may or may not be an option for you depending on a lot of factors that your financial planner and your tax pro is going to have to help you unravel. And I absolutely would encourage you to not take this as financial advice, but talk to them. You do need to keep the big picture in mind when you're planning, and if I can help, don't hesitate to contact me using the link in the description. Well, listen, one last thing before we go. Hit that like button if this was valuable for you, and subscribe to my channel if you haven't already. Thank you so much for watching.